Okay, so Greg and I put together our thoughts for this yesterday and organized the whole call. And in between yesterday when we organized this and now, I've gone a little rogue, and all day I've been adding to things that I want to say. So I'm just going to kick off with some thoughts that I have in mind right now, and then get into what we had planned for the call. So one of the things that we read this morning is that the average decline from like peak to trough, or when you're bottoming out in a bear market, is 8 months. We've gone to deep into bear market territory at this point on the market in less than 1 month. On February 19th, not even a full month ago, the market was at an all-time high. And here we are with a really miserable market. I think that as quickly as we've moved down, when this starts to turn around and when things start to improve and when we start to get real information and see a declining rate of infection, I suspect that the first leg up of the market, maybe first and second legs up of the market, will be as viciously fast on the upside as they have been on the downside. One of the things that we talk about that I remember saying a lot during 2008, 2009 was we can look to the market, we can look to history as our guide. We can look to history as our
Jenny?
guide. Yes?
It's really breaking up bad.
Oh, really? Is that, hold on.
Yeah.
That is so weird. Okay, hang on for 1 second. Is anyone else breaking up a lot, or is everybody else okay?
Before I could hear you, now it's all gibber, garbled. Dial in again.
Fine.
Greg, how about you? Are you getting it garbled, or are you getting it okay?
I'm hearing it fine.
Okay.
I can advise anyone
fine.
over the phone. It's very clear. If you're having trouble, you can dial in via the phone, and that's pretty clear.
Yeah, and I am dialed in on a phone, and it was great, and then it completely lost. So let me dial in again.
Okay, sounds good.
Jenny, the video is toggling between you and Greg's name on the screen, like cycling through that. So I'm not sure why it's doing that, but just
okay. Let me spotlight myself. Hang on.
Yep.
I'm going to dial in again.
Okay. Okay, is that better?
We can hear you.
Yes.
Great. Okay, everyone's on mute again then. So where was I? Okay, so in 08, 09, something that I found myself saying repeatedly was we can look to history as a guide. We can look to history as a guide. Right now, with respect to how the market's going, how society is going to deal with this pandemic, we cannot look to history as a guide. We do not have a guide for anything like this. But what we do have a guide for are a couple of behavioral things. And those are, one, we know that the market always overshoots, right? It overshoots on the upside, it overshoots on the downside. We also know, and this one's like pretty much 100% guaranteed, we know that the people who lose their minds and lose their marbles and panic and sell in the times of the most distress and the most fear, we know that they lose out 100% of the time. So it's particularly important right now to look to history as a guide to see how people have fared in past times when they've made behavioral decisions. Okay, one of the other things that I think is kind of interesting is that just for our dividend income portfolio, and we'll get into this later, the income, and I'll get way into this later, we've been going company by company by company over and over, looking at the security and safety of the dividend. If we sat tight right now, just the dividend income that's going to flow into portfolios would put almost about 6.5% back into portfolios between now and the end of the year, just from cash pouring in. So that alone gives me a little bit of comfort. And then the last thing, one of my clients is a really cool guy who can't be on the call, but called to check in ahead of it, is a professional. He was a banker, a professional banker. And wait, yeah, okay. I just want to make sure my sound is fine. Again, Greg, my sound is fine, right?
You're fine. Yes, I can hear you perfect.
And so he's a professional banker, professional investor. He called to check in. And I had joked with him that last night when I was doing the dishes, I thought, if he ever loses his marbles, that's when I'll be scared. So when he called, I said, "You're not losing your marbles, are you?" And he's like, no, I'm totally cool. I'm actually trying to figure out when to put more money in. But he said something that I thought was really important. He said, the most important question for people to be asking themselves is, does this change my life? And I think for all of you on the phone who've worked with me for a long time and have been through really tough cycles before, and know that that income's going to get there, this should not change your life. Like, I've been joking today that from the neck down, I'm having a heart attack, and from the neck up, I'm cool and calm as a cucumber. I know logically we're going to get through this. We're Americans, we survive everything. We're flexible, we're resilient, we're strong, and we're going to get through it. But it does, I cannot emphasize enough how rotten this feels, and we're all feeling that right there with you. So, okay, this is what the proper call was, and this is what Greg and I planned out. We have a strategist who we love, a guy named Ed Yardeni. And one of the things he said in a recent piece was, the cure to a viral pandemic, by the way, I'm looking at my notes, that's why I keep looking down. The cure to a viral pandemic is a viral panic. So the cure to a viral pandemic is a viral panic. And what that means is the panic response that we're going through right now is the cure. So while it feels horrible, we're in the curing process. And I don't want to come across as Pollyanna. I know how severe this is and how scary it is for all of us, but we're in the curing process. So, you know, doing the social distancing, having the Fed and the government just throw tons of money at the economy to support it. These are parts of the cure. One of the things we've been thinking about a lot, and we always do this in the investment business, is look for analogies, right? What can we look at to understand this situation better? And so, and you're all welcome to argue with us about this not being a great proxy, but in some ways I think it is. We're looking at China and what's going on with China right now. And you can say, oh, but China has tighter controls and they locked it down in a way that we haven't yet. But the reality is too, they started dealing with this in December. They didn't even acknowledge that it was a real problem until mid to late January when the world forced them to. And so we are looking at China right now as a proxy. So I'm gonna ask Greg to touch on a few things that we're looking at there.
Yeah, I think it's encouraging to see what's happened with China. China imposed the lockdowns. It was January 23rd, and here we are. It's about 8 weeks later, and right now China has about 20 new cases per day, and all of the new cases of coronavirus are from foreign sources. So it's people who traveled abroad and then bringing the virus back home. They've got no local outbreaks in the country right now. So, and now I think the important thing is that the economy is already coming back in China. Things like Starbucks has reopened 90% of their locations. Other large retailers are reopening. Coal consumption, which is a proxy for how much power the country is generating, it's only down about 10% compared to last year, and it's on a path to recovery. FedEx announced this morning that in their earnings that large manufacturers are back to 90 to 95% of their previous capacity. Smaller manufacturers are a little bit slower to get back, but they're still, operating at the 65 to 75% of capacity. So, the long story short, China is coming back economically. The virus has gone away. So that we look to that as hope for what may happen in the U.S., although it just takes time. That we're putting in in a slightly different way. We're imposing lockdowns and quarantines, so a little less, not as severe as Wuhan, but more widespread. We're essentially locking down we're suggesting less activity across the whole country for impacting more people.
Yeah, so on that subject, one of the things that we're thinking about is activity and how it affects GDP and the economy. And the reality on that is we don't know, right? And nobody knows. And that's really what this whole thing is rooted in, is this real lack of knowing what's happening. Here's another place where we can look to history as a guide. We can look to history as a guide, and we know that the market hates uncertainty. And the market's at uncertainty. I'm at uncertainty. I have no idea when my kids are going back to school. Everyone's at uncertainty. When can we go to restaurants or out to Broadway shows or do anything fun again? So it's not just the market that's experiencing tremendous uncertainty right now. It's everybody, and that's really tough to deal with. So with respect to the economy, we know that we had 2 good months, right? January and February. We know that March is grinding to a halt. We think that the second quarter is probably going to be a throwaway, and we're going to have a recession in the second quarter. It's hard to imagine that we don't. Recession, just to be clear, is when gross domestic product growth declines. So we're going to have negative gross domestic product growth. That'll probably carry into the third quarter. And then we think that there's a really good chance that there's a lot of pent-up demand for all the spring breaks that have been postponed, for all the trips to Disney, for all everyone's wanted to do. There's going to be a lot of pent-up demand that might come in the later half of the third quarter and fourth quarter. So 2020 isn't a total throwaway year. Even if earnings growth collectively is down this year, it's not all for nothing. It's not that there's no economic activity going on. It's just a very, very reduced rate for 4 to 6 months, and then hopefully we start to rebound. One of the things that we've talked about is the monetary stimulus by the government. And just to give perspective on that versus 08-09, the real monetary stimulus really started to kick in 2008 in October. This is kicking in now, 2 weeks into when this real crisis started to heat up. So for what it's worth, the banking system in the market is being supported in a way that it wasn't the last time we suffered this way. And I want to say something on that too. The market, as of this morning, and now it's down a bunch more today, but as of this morning, the S&P 500, if we're going to use that just as an easy benchmark for the market, was down about 21%. In December of 2018, the S&P 500, when it had traded down from October through December, was down about 20%. So in terms of wealth destruction, we're actually about the same as we were in December of 2018, which felt bad, but it didn't feel anywhere near as bad as this time around. This feels horrible. This is truly scary and disorienting and terrible. But I think all of these measures that have been put in place to support the economy are part of what is helping the market stay as stable as it is. So that's, doesn't feel good, but I think it actually is a good thing. I also think that because of that and because of lower oil prices, which is a separate conversation too, I think we're going to come out of this with the wind at our backs. And this is something, Greg, can you touch on this a little more too?
Well, yeah, I think when the coronavirus is finally has settled down in the second half of the year, the consumer, there's going to be a lot of pent up demand. Money is not getting spent, but for the consumers who have income, that income is going to get saved, and we're going to have low interest rates. There's already a mortgage refinancing boom that's going on, but low interest rates typically has been a great catalyst for consumer spending and the housing market. And we also have very low oil prices and gasoline prices, which will immediately put money back into the consumer's pocket. So when this does get settled, the U.S. consumer is going to be in great shape. If for the ones who are still employed and as industries get back to normal, I think the consumer will do well.
Yeah. So then this gets us into the question of what are we doing about it, right? What are we doing for you and for your portfolio? So I'd say the primary thing we're doing, which is getting exhausting, and Greg and I are seasoned professionals. We've done this many times before. We've done this through 08, 09, which from a monetary perspective, from a market perspective, is way more painful than this. We are just relentlessly consuming as much information as we can get. And the problem is that there's no real information yet, right? But we're getting everything we can and we're assimilating it as quickly as we can from the big macro perspective as well as from the company perspective. So we just keep going through the list of the companies we own over and over, and we're looking at what the earnings expectations were. We're adjusting them where we can. We're talking to the companies themselves. We're reassessing the stress test scenarios that we used when we initially bought them to make sure that through thick and thin that dividend could be supported, like even with the craziness of what's going on now. And we're just checking and rechecking and checking. But the thing I think that's really the most important that we're doing is we're talking to you, and we're talking to our clients through the emails, through the big letters that we've been sending to clients, through email dialogue, through text dialogue, through phone conversations, through this conference call. Because what I've found is, the longer I've been in this business, is it doesn't matter if you have the best returns of any portfolio manager ever. If I can't get you through right now, then any amount of good work that I ever do is for nothing. Because if you cash out now, this history is our guide that is a losing strategy. So what I've tried to do is put together this portfolio that you can, it's not just a portfolio of like mutual funds or exchange traded funds. Here is 36 stocks that that you can understand, that we can look to, and we can say, hey, Pfizer stock might be down 25% right now. That's crazy. Anyone who's taking Lyrica for their diabetic nerve pain is still taking Lyrica. That dividend is safe. The earnings are safe. Just because it's down 25% doesn't mean that there's anything actually wrong with the company. Or you're watching over your iPhone right now, which means that you're using Qualcomm chips and you're probably using AT&T or Verizon service, maybe Sprint, but those companies are just fine and the dividends are fine. And so I just keep going through the portfolio over and over. And looking at it like that. Just an aside, one of the companies and we're calling management teams over and over, but one of the companies that's not in that easy, like, I can go explain to you how life doesn't go on without AT&T, or how life doesn't go on without being able to back up your cell phone to a data warehouse that uses Western Digital's hard disk drives to do it, and it travels over CenturyLink's fiber. One of the companies that I spoke to yesterday is Navient, and they're the student loan processor. And it's so interesting. So here you have a company that a month ago reported fantastic earnings, right? Stock was trading at $15. Everything's firing on all cylinders. Here we are, a short month later, stock's down 66%. The dividend yield's like 13.5%. And I call the company, and there's two main triggers, right? There's interest rates, and then there's the worry about student loan cancellation. And they say, Jen, and so I'm talking to the management, and they're like, Jen, you know this. You know that lower interest rates are actually directly beneficial to us. They actually, they lower our borrowing costs, and we make way more money when interest rates are low. So that's just good for us. Second of all, the language on the holiday for student loans specifically was for student loans that were federally held. And so that doesn't include what we have here. And then even if it starts to, the government would back that up. So then it would be the government paying the interest payments on these for the next few months. So we keep going company by company and seeing these disconnects. There are a few in there, where maybe 3 right now, where I think, okay, I don't think this quarter, but maybe in the future, the dividends could be at risk, and we'll handle those one of 2 ways. We'll replace them like we always do when that comes to pass. But we're also looking at companies and saying, here's one, for example, Ryman Hospitality Properties. They're one of the largest non-gaming conference centers in the country. That the share price of that is being treated like they're going bankrupt. They're probably going to miss 2 quarters of revenues. That's really bad. I've spoken to the management. They have $850 million of cash. They can sustain this. They have no debt coming due until 2023. And each giant hotel conference center that they build costs about $1 billion to build. Meanwhile, the stock, just because it's crazy and it's swept up in all of this fear of like all hotels are closing, the stock is trading at a market cap of about 800 million. So someone could come in and just buy the entire company, and it's probably worth a minimum of 5 times what it's trading at right now. So that's the kind of craziness, and it's our job to sit back, stay cool, make sure that you're okay, make sure that we're making smart decisions and that we know the reality of what's going on in there. So a couple of last things, and then I'll wrap it up and open it up to questions. But we sent out an email. The weeks feel like months lately. I think it was just last week, where we included a chart of, if you worked with us from the beginning, what the dividend income would look like. And you can see that even through 2008, 2009, even through the worst of 2011, when there was a U.S. debt downgrade, in 2013, the taper tantrum, in 2018, when we just had a huge 20% pullback, the dividend income has been steady to increasing through all of those periods. If for any reason you want that chart again, just let me know, and I'll send it to you. It's like wonderful to make you feel better. So then I'll say this: from a market decline perspective, we've been through worse. We know how to handle this from a market perspective, from a stock market investing perspective. From a human perspective, we haven't been through this together. No, we haven't been through this at all. No one has. We're going to get through it together, and we're going to be okay. But it feels rotten. So, thus the Misery Loves Company title of this conference call. And then I'll leave you with one last thing before we open it up to questions. One last thing. There's a meme going around on Facebook, and it says, "Your grandparents were called to go to war. You've been called to sit on the couch. I think you'll get through this." That is not for you. I think that's for the people who are hoarding 42 boxes of toilet paper, 2 years worth of toilet paper. So I just think this is terrible, and it's scary, but it's also something that we're going. So that's about it. I think we should open it up for questions. And again, don't feel like you need to say your name unless you want to. Okay, and we'll try to manage it because there's a lot of.
Jenny,
Yeah?
Jenny, can I ask a few questions, please?
Sure.
Yeah.
Hello? Yes, can I be heard, please? Can you tell me?
I can hear
Are
you.
you hearing me?
Yep.
You can. Okay. So, Jenny, I got a notice on March 10th that you made 5 trades.
Okay, you know what? Because hold on for 1 sec. Hang on. Everyone's portfolios are different. So if you don't mind, can we just talk about like portfolio specifics and trades one-on-one, and can you just call me?
Yeah.
Is that
Okay.
okay?
What
Please call
happened to Target?
Okay,
What
sorry.
happened to Target? We bought Target at $11. It's under $5 now.
Right.
They're
So
paying a
again, not
dividend
everyone
of
owns
over
Targa.
50%.
Okay. So Targa, I spoke to the management last night. There's a couple of things going on with the whole MLP group, or the whole midstream group, which is a lot of these stocks are in midstream. Are in closed-end funds and ETFs that use leverage. And so what's gone on there is Saudi slapped Russia across the face on oil prices a week and a half ago, right? Oil prices came down. People started purging their MLPs. Oil prices came down more. Some of the producers started to cut their production numbers. And it's just going around and around in these closed down leveraged funds that hold companies like Enterprise, Magellan, ONEOK, Williams, Targa. You guys all own some of these. Everyone in the U.S. dividend income strategy owns some of these. And so it's going around and around. And the leverage is washing out. I spoke to the management team of Targa last night at 4:30, and they walked me through the cash on hand. I looked at the debt maturities. They have no debt maturities until 2023. They talked to me about the assets that they've got, about where they're located in the Permian, how they're going to come out of this. There's a chance, that's one of the ones that I worry about. There's a chance they're going to trim the dividend. I don't think they're going to cut it all the way. I don't think they need to. But that's one of the ones where I said to the CFO, please help me distill reality from what's going on in the market, because it's clearly disjointed. Okay, anyone else got questions?
Yeah, Jenny,
Yep.
this is Old Saybrook. One thing I've read in a couple of places, and let me know if you can't hear me, is
I can
that
hear you perfectly.
Beating down the coronavirus current outbreak globally may not be a one-shot process,
Yeah.
but it might be extended over a longer period of time than 6 months, and maybe more like 12 or even 18, where it's sort of like Freddy Krueger, it keeps coming back a little bit in smaller localized outbreaks, meaning that this social distancing stuff and all that might we might bounce back. You talked about pent-up demand, that makes sense, but it might bounce back. I mean, have you read anything like that?
Yeah.
And how does it affect the strategy?
Greg, do you mind jumping on this? We've been talking about this a ton, and we can talk about weather, and we can talk about the recurrence. But Greg, do you mind answering that one?
Sorry, I missed part of the question. I have a technological issue here.
It's about the recurrence of coronavirus.
The recurrence, oh yes. So the virus has spread globally, so there's a chance. Can you still hear me?
Yep, we can hear you
There's
perfectly.
a strange feed. The virus has spread globally, so there's we're in the northern hemisphere, we're heading into summer, so the viral activity should slow down, but while the southern hemisphere, the virus activity will be picking up, and there is a chance that the virus becomes a worldwide, never-ending virus where it continues, building up in different parts of the world. We have seen some evidence that some studies, especially in China, where once you have the virus, you can't be infected again, that there is a built-up immunity, which is, I think, part of the reason why the rate of new infections in China has plummeted so much. But with a lot of things with the virus, we just don't know. Other instances between SARS or MERS or swine flu, we haven't seen those viruses come back. They were one-time events. Those were likely all smaller than this has been, but we'll have to wait and see.
Mm-hmm. Yeah. Okay, thank you. Who else has questions?
70%. Lost half our money in that.
Anyone else got questions?
Don't lost half the million.
Hi, Jenny, can you hear me?
Yes.
I had a question on Sabra. I mean, it's a REIT. It can't cut its dividend just because it wants to. I mean, it needs to pay out its earnings.
Right.
It seems to be trading like everybody in those nursing homes is going to die rather than continue to pay rent. I mean, how you feeling about Sabra?
Right. So I think, hold on, I'm just going to mute again. Okay, so I think one of the ironies of Sabra, and by the way, we've got a call set up with the CEO for, I believe, tomorrow. We've got Hannon Armstrong tonight. We've got Sabra tomorrow. So one of the things with Sabra is, people are, I know this sounds terrible, but people are trapped there. And frankly, it's the best place for them to be. My partner, Jonna, her in-laws are in a skilled nursing home, and she's saying, thank God they're there, right? They are isolated in a functional way. They're being brought food. But I think this is part of where the craziness of indiscriminate selling really shows up, in that it's just being sold. I mean, literally indiscriminately what's going on with their revenues, what's set in stone there. In fact, I've got the coverage ratios right here. It's the dividend coverage is multiple times covered. It's just fine, but it's being sold down because what's the thought that no one's ever going to go into a nursing home again after this because some of this started in Seattle? No, that's not the reality. The reality is these are what's the right word? Like they're necessary businesses, right? And they're necessary places to be, and they serve a huge positive functional role in society. So I think this is one of the many ones where there's just a wild disconnect. Okay, who else has questions?
Jenny, it's Bob.
Yeah. Hi.
So do you see avenues of where we can, and when should we activate this? We should be buying stock that we hope in the future will pay off.
Yeah.
Right.
Yeah. So that's the fun part. And I should have touched on that more in the in my opening comments. But in addition to researching and looking at each of the companies that we have on the list already, there are stocks out there right now, and I haven't quite pulled the trigger, but there are companies out there right now where we're going to get some unbelievable bargains. So for example, yesterday, Pattern Energy, which we bought about a year ago, was sold, and it was sold because a Canadian pension fund bought it for cash in the portfolio. So now we have the cash from that position, we've got all this dividend income coming in, and that's going to allow us to buy new positions, or we can sell out of some of the stocks that aren't performing as well, or just I think are ready to be sold. We can sell out of those, and we can start to buy new things. So what's on the screen right now, which I've never seen on there, and I'm not quite ready to buy these, but like UPS is on the screen. In all my life, I've never seen that have a high enough yield to actually consider investing in it. UPS is on there. Cisco Systems is on there. 3M is on there. Vornado Properties in New York is on there. There's some really, really high quality companies that are getting cheaper and cheaper by the day. So yeah, a huge part of what's going to make us successful coming out of this is being able to pounce when those are ready. And we're just teeing up the research and teeing up the research. I don't know if many of you remember this, but we used to own a company called Paychex that does all the payroll processing, and we sold that several years ago, but that's back, right? That has a 5% yield again. So as we come out of this and everyone goes back to work, if that share price doesn't explode to the upside, and we know when we have some visibility there, like maybe we buy Paychex again. It was a terrific investment, and there's no reason it shouldn't be again. So there's a lot to do. Like we are at the point of maximum busyness here. Thank you. Okay, what other questions? Anyone else got anything?
No, don't think so.
Don't be shy if you do.
So I got one more question. You mentioned earlier that you thought Targa or one of the companies might be changing their dividends.
Yeah, so Targa I think might, and that's a wild one because that's changed between like 5 days ago and now, and it has to do with just how severe this kind of like cycle's been. But I don't think they're gonna cut. I don't think they could or would or even need to cut it to zero. Like maybe they cut it by 25% or maybe 33%. And if that's the case, that's fine. We can keep holding it. So what they need to do and what they will do is, which is what the CFO said, is they need to put out a press release, and the press release needs to distinguish reality from fiction that's floating around out there. And at that point, I think the share price goes up a lot. I think they'll get more visibility as oil prices start to stabilize. Oh, one thing on that, on oil prices stabilizing, which leads into Target and all of the energy companies. One thing is that I think there's an old saying that says the solution or the cure for low oil prices is indeed low oil prices, because as oil prices are lower, then a lot of the producers start to cut off production, supply goes down, prices go up. I think that's going to hold true now too. And when we went through this in 2015, 16, when oil prices were about the same level they are now, and it was really dire and really, really terrible, it only took about a month for oil prices to significantly recover from there. If we think about, and I don't want to get too wonky right now, but if we think about what Saudi Arabia's real cost of oil production is, once you consider all of their social costs in production, they really need to maintain a much higher oil price So I think that what's going on in the energy space might be relatively short-lived. But that's what'll dictate what goes on with Targa. All right, anyone else?
No, I don't have any.
Okay. Okay,
No.
so listen. Yeah?
No, thank you.
Okay, I'm just here. Okay, I'm not going anywhere. If you're someone who doesn't like to ask questions in a big group, please just call me. I'll pick up the phone as quickly as I can and answer any and all questions, okay? And if you all think this is helpful and you want to do it again next week, just let me know. We can do it as much as you'd all like.
It's very good, Jenny. Thank you.
Yeah, thanks,
Thank
Jenny.
you. Thanks, everybody. Okay, I'll talk to you all really, really soon.
All righty.
Okay, bye.
All right,
Thank
bye-bye.
you all so much.
Thank you.
Thanks, bye.
Bye-bye.